newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Qatar Economic Forum in Doha, and these are your headlines. Donald Trump's massive tax and spending bill returns to the House after overnight negotiations on tax deductions and healthcare cuts. Investors push back against the prospect of a ballooning U.S. deficit with 30-year Treasury yields hovering near 20-year highs. Plus, the South African president insists that talks with President Trump were constructive despite being ambushed by claims of genocide against white farmers. Now, first thing is first, we have a lot to get through, a lot of news today on this Thursday morning. But actually, let's look at the markets. Stocks in Europe and Asia are definitely falling, and this is on concern over the U.S. fiscal outlook. That's triggered a broader risk off-tone across markets. Now, bond market, let's focus on the bond market. We're looking at cross assets, really expressing some of the sentiment that the cost of capital is rising. Risk assets, they think, need to be rejustified amid concerns over the U.S. deficit and tax bill. Now, we're also getting some data points out of the euro area. PMI, composite PMI, falling to 49.5. Forecast was above 50. Now, we also have a bit of IFO business confidence. That index at 87.5, pretty much in line with expectations. Now, U.S. lawmakers are currently debating a new version of President Donald Trump's massive tax and spending bill. The revised legislation, including a higher limit on the deduction for state and local taxes, and other changes in a bid to win over warring GOP factions to support the multi-trillion-dollar package. Now, voting on the bill is actually expected to take place shortly. For more, let's bring in our EMEA news director, Ross Matheson. Ross, I'm losing my voice, but what's in the bill and what are the main sticking points?
Well, as we can see, there's a debate going on at the moment in the House on this that possibly will run for a few more hours, and then we're likely to get that vote. It's narrow, but at this point, the expectation is that it may pass. Obviously, this is a massive bill. There's so many things in it and so many things being attached to it, which makes it very complicated, as it goes on. But it's for Donald Trump, it's the ability to preserve his tax cuts and say to the American people, I've made good on my promise to do so. And also on his campaign promises to have, obviously, no tax on tips and on overtime. You can deduct your interest payments on your car if it's a US-made car. So that's obviously trying to push on to the American taxpayer those benefits. But there's also a lot else that's in here. And they're the sticking points, obviously, which are around Medicaid, perhaps some of the accessibility of Medicaid for some American people, and making that quite stringent. That's what Republican hardliners are pushing for. There's also been a long conversation around the ability to make deductions for state and local taxes if you're also paying federal tax and what that threshold should be. And it seems like there might be an arrangement now around that. And it's also about how quickly to roll off some of the tax credits that Joe Biden put in, the former president, around clean energy. And you can see the impact potentially for renewable companies out of that, and shares moving in Europe, in fact, on that today. So it's sprawling, it's big, it's contentious. The question is, if it gets through the House, then obviously what happens to it in the Senate?
Yeah, what impact would the bill have if passed?
Well, obviously, it's a big win for Donald Trump in some aspect, because he can say to American voters, I've preserved these tax changes for you. There are big question marks over how much the SALT changes might benefit many taxpayers, how broadly that would benefit. For him also, there's the political question. If you have the Medicare changes brought forward and fewer people accessing Medicaid right into the midterm elections, is that politically tricky for him equally? And for markets, there are fundamental questions. Again, you can see it in the bond market day after day at this point about the fiscal impact of all of this. What does it mean about the level of debt the US is carrying? And you can see the concern about just piling more debt onto that, especially if the debt window gets raised again through this bill. And so the questions of impact, it's a bit hard to know, given we don't know what the final bill might look like once it gets through all the contortions with the Senate and so on. But politically a win perhaps for Donald Trump on one part of it, and a bit of political risk for him on the other as we get closer towards midterm elections.
Ros, thank you very much. Ros Matheson taking us through the impact of what we're seeing developing on Capitol Hill right now. I'm Anna Edwards, just going to jump in for Francine while she recovers her voice live there at the Qatar Economic Forum. Let's go to the market response, though, to all of this politics in Washington. Concerns about the tax cut bill and the ballooning US deficit triggered a sell-off in treasuries. Let's get the details with Bloomberg's Valerie Teitel. So is the bond market sending a bit of a warning signal then here, Valerie? We saw this at the beginning of April where President Trump conceded that the market had got a bit yippy, in his words. Are we seeing another signal coming through from markets?
The bond market sure did feel yippy yesterday. What a rise in the long end. I think that's telling us that this bill, even though we don't know the full context of it yet, does seem to entail a bit too much spending for what the Treasury market wants to see. Over the last 2 days, we've now seen those 10-year yields. Ooh, there we go. Breach 510 yet again. We are very, very close to breaching cycle highs. Take a look at this next chart, though. I want to point out there was another catalyst that happened yesterday. It was a weak 20-year auction that happened around 6 p.m. London time yesterday. This yellow line is when that auction happened. Not only did it sink Treasury prices around the curve, but it also sank the equity market. The equity market, S&P 500, declined over 1.5% after this weak Treasury auctions. These higher yields, Anna, are really, really feeding into risk appetite when it comes to the equity market.
And put the 30-year move in some context for us, Valerie, because I was reading notes yesterday from various houses. They're quite surprised that their attention has had to go to the 20-year auction because that was not an area that the market usually focuses on. Sure, the 30-year, more tested area of the long end. But give us the longer-term context here.
Well, Anna, we are very close, less than 10 basis points away, actually, from breaking cycle highs in the 30-year yield that was reached in October of 2023. If we do breach that level from 2023, we have to go back 18 years, all the way back to 2007 to see comparable highs in these 30-year yields. And again, I just want to mark how strange this is to see at this point of the cycle when we're having an economic slowdown in the U.S. We normally see long-end yields rally. That's something we've not seen, and that's due to the fact the market is so focused on supply and demand concerns. The other thing that stands out as odd is normally when we have Treasury yields rising, that does help the dollar out. That's not been the case this week. The Bloomberg Dollar Spot Index hit a one-month low yesterday, and it's down 1.2% so far in this week's trade.
Valerie, thanks very much. Bloomberg's Valerie Teitel with a nice setup on what's happening in the bond markets. Well, no surprise, that was part of the conversation with Jamie Dimon that Bloomberg hosted earlier on today. Jamie Dimon says he can't rule out that the US economy will fall into stagflation. The JP Morgan chief executive says there are huge risks and he believes the Fed is right to hold. Dimon's been speaking exclusively to Bloomberg's Haslinda Armin.
Talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So, I saw last night's reaction. I don't worry about one day move in bond markets. So.
You don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher, and some are talking about 10's getting to 5, 30's getting to 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah. I don't know the answer to that. That we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. And the infrastructure needs are inflation. And now you have offsets. You have oil prices down quite a bit, which is quite deflationary. But with all those things taking place, you may be surprised.
As we said, it is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like?
Yeah, so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which you say it's not, but it is still higher than what it was before.
Would it go higher?
Will it go higher, and also will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up, and they can't control. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be.
The JP Morgan Chief Executive Jamie Dimon, of course, speaking exclusively to Bloomberg to Haslinder Amin, in fact. Now, over in Doha, over at the Qatar Economic Forum, Francine is back. We think she's rediscovered her voice. It's been a really busy day, Francine, but I'll let you take it from here. But I'm not going anywhere, just in case.
Yeah, thank you, Anna. I am back, and actually, thank you to the air conditioning, but also to the lockets that now are helping me get back on track. So we're here at the Qatar Economic Forum. Let's get more on how investors are navigating the market jitters as the House debates Trump's massive tax and spending bill. With me now, Christina Minnis, Global Head of Acquisition Finance at Goldman Sachs. Christina, thank you for all the time that you give to Bloomberg. I mean, there's a lot going on. We talked about credit, we talked about pockets in the markets that look maybe expensive. What are you seeing?
Well, there's a tremendous focus right now on the convergence of public and private markets. And when you look at the capital needs that are a lot discussed here at this conference, we see sort of a $17 trillion figure that it's bandied about for the investment in infrastructure and energy transition. And watching the capital markets really innovate to support that need is super exciting. And our recent formation of our Capital Solutions Group is going to optimize and really create great, hopeful solutions for our clients. So we couldn't be more bullish on the future.
So where does that capital actually get deployed in terms of region, but again in terms of sectors? Is it difficult to find a home for it?
Not a difficult place to find a home. A couple of interesting statistics. I was on the phone with our heads of our TMT franchise, and it's interesting, 50% of data centers are in the U.S., which means 50% are ex-U.S. Now, that's been historically predominantly in Europe, and now we think a huge opportunity here in the Middle East. So there's a tremendous amount of activity, and around the sectors, I would say, things that you've heard for years around tech, of course, but also healthcare, research, natural resources, energy transition. It's just a significant opportunity to invest in these industries.
Christina, what are you doing in the region?
In the region, I'm here basically. I was serving on a panel on AI, and my topic was to talk about capital formation, supporting this huge growth of capital requirement. And I think a lot of folks are sort of somewhat daunted by the size of the capital need, but when we think about it at Goldman Sachs, we're very confident that the innovation in the credit markets are there to support this need, and that it's much more about finding the right structures to support these clients.
And so again, it goes back to this public-private partnerships, but a lot of the money, I guess, that comes into the region, maybe stays in the region more than in the past.
Yes, and I think there's a lot of focus to invest in the region and also partner with key strategic players in the region and globally.
Christina, where do you see, some of the Trump policies, again, when you look at syndicated loans, when you get at some of the, the products that you offer at Goldman Sachs, do those change or do they adapt, again, to where money needs to flow to?
Yeah, I don't think there's any change in the Trump administration that affect our credit markets right now. I think they're innovating at a very rapid pace. And again, there's a lot of discussion about somewhat the friction between private credit and the public markets, and we just don't see it that way. We think both markets are very valuable to investors and issuers, and they're growing at different paces, but they're significant markets. And so do I see anything stopping that growth? I don't.
Have your clients' needs changed in the last 6 months? Have your clients' needs actually changed in the last 6 months?
There are more clients looking at the class. Private investment grade is something that wasn't really discussed even 2 or 3 years ago. And so now we see a lot of interest from investors across the spectrum to look at private investment grade. Private credit markets historically were focused on below investment grade.
Yeah, and it feels like it's just at the beginning for that market really to flourish and grow.
Yes.
Right. Is that more than some of the credit? I mean, we talked a lot about higher valuations or some of the, concern regarding the private markets. Again, what are you hearing on the ground from people saying they worry about top valuations?
Look, I think valuations continue to be lofty in certain sectors, and there's a lot written about that. I think there are many companies that will potentially stay private for longer. And the good news is there's a tremendous amount of private capital to support those companies. So I think there's a focus on, can these companies access the capital to hit their growth plans? And the answer is absolutely yes.
Well, when you travel around the world, where do you see the biggest opportunities region-wise?
Well, I would say right now is a very big focus again on Europe, which I would have said a couple of months ago there was concerns. Of course, the U.S. And then I think here in this region, there's a tremendous amount of interest in this region based on all the things this region has to offer in terms of capital, energy, land, research, and science. So we're very excited to be here as well.
Europe, is it defense? I mean, I feel like a lot of the defense spending, certainly from Germany, has given a little bit of a boost to investments across the board.
I think in Europe, there's going to be obviously a tremendous amount of investment in defense and security, but also across the spectrum in AI as well, and healthcare and research. So I would expect to see investment in Europe, not just in defense.
Where does it, if you look at AI infrastructure?
Yes.
I mean, it's at all top levels, right? Where do you see the biggest value creation over the next 5 years?
I would say in terms of the opportunity set, in the middle of the stack where there's like the infrastructure build out from a credit perspective, there's tremendous need for capital there. But I think across the entire spectrum from very early stage companies through to applications, there's a tremendous upside. And we couldn't be more excited about that opportunity set for our clients and also being there to support them with capital.
Christina, thank you so much for joining us. That was Christina Minnis, Head of Global Acquisition Finance at Goldman Sachs. Now, coming up, the South African president is the latest leader to face a White House showdown. We'll have the details of his meeting with Donald Trump. That's next, and this is Bloomberg.
I can categorically state that there is no genocide in South Africa. There are crime problems, there are issues, there are contentious issues around land, and I think President Ramaphosa tried to land that point last night in a very difficult situation. But the beauty was, we saw a government of national unity in action. We saw the leader of the opposition actually back up his president.
Du Toit there, the chief executive of investment management firm 91, speaking here at the Qatar Economic Forum earlier about false claims by President Trump of a genocide against white farmers in South Africa. Well, Trump's meeting with South African President Cyril Ramaphosa at the White House yesterday was seen as a chance to mend strained relations between Washington and Pretoria. Instead, Trump used the opportunity to repeat his genocide allegations by showing a video that purported to back up his claims that white farmers are being targeted.
If there was Afrikaner farmer genocide, I can bet you these three gentlemen would not be here.
Occupy land, South Africa, occupy land.
Each one of those white things you see is a cross, and there's approximately 1,000 of them. They're all white farmers, the family of white farmers.
There is criminality in our country. people who do get killed, unfortunately through criminal activity, are not only white people. Majority of them are black people. And we have now
the farmers are black. The farmers are not black. I don't say that's good or bad, but the farmers are not black.
Well, I'm joined by Arjit Ghosh, our Africa managing editor. Arjit, frankly, I wasn't sure what we were watching, right? The meeting seemed to confirm the fears of some of Ramaphosa's advisors who believe he was walking into a trap.
Yeah, I think, they would probably were aware that they'd probably see this action there right now. But I think if you just look at the numbers that we have been kind of reporting about 72% of white farmers own kind of the land there, and they are just 7% of the population, really. So the data really doesn't back up what President Donald Trump has been talking about. Again, if I may throw some more numbers at you, there's a huge problem of crime in South Africa. Nobody denies that, and we heard Henry Dutoy talk about it, President Ramaphosa talk about it. But if you look at the numbers, 27,000 murders in Africa last year. 0.2% were in farms. So again, the data doesn't support the claims that Trump has.
So, President Ramaphosa, stay cool. I thought he handled it, pretty well. But where does that U.S.-South Africa relationship go from here?
Yeah, very good point. What we are hearing, we heard the finance minister Enoch Godongwana just talk about it as well. He is not there at Washington, but he has been getting feedback, and he says that what he's hearing is that there's hope for a reset between the ties between the two countries, really. That's all behind cameras that, President Donald Trump and President Ramaphosa talked about trade, for instance. So there is hope that there would be some reset in relationships. Ramaphosa wants to see Trump come to the G20 summit in Johannesburg, and he said that he's hoping that Trump will be there.
Yeah, and I wonder, it's not really about diplomacy. I guess it's about, President Trump and the White House playing to a message back home.
That is exactly what is happening in terms of President Ramaphosa's. I think he's getting a lot of support from what we've been hearing back home in South Africa, really, and hopefully that will help the government of national unity as well as they progress into a lot of contentious laws that are coming up, including the expropriation law and the healthcare law that have been in the works for a while now.
Arjit, thank you so much for joining us. Arjit Ghosh, they're in charge of all of our continent's coverage. Now, this is what's happening on the plenary stage here at the Qatar Economic Forum. Rob Barnett, senior energy analyst at Bloomberg Intelligence, is speaking about the race to power AI. Let's listen in.
Quickly, I have a chart up on the screen just showing the solar names. They had a really rough 2024, also a challenging 2023, despite a lot of optimism from the U.S. president and the prior administration. We think they are back to growth in 2025 and future years as well, even with all the discussion about tax policy that's going on in the U.S. So look for solar names and storage names to be geared to the idea that data centers are rapidly propelling power demand. We think that the hyperscalers, despite their ambitions to be carbon neutral and all of their ESG goals, are a very practical lot. They are focused on rapidly scaling AI, and we don't see how you get there without a significant...
Of course, terminal subscribers can continue to watch that on Live Go. Coming up, Israel tightens security at its embassies after 2 members of staff were shot dead in Washington. We'll have plenty more on that next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Qatar Economic Forum in Doha, and these are your top stories. Donald Trump's massive tax and spending bill returns to the House after overnight negotiations on tax deductions and healthcare cuts. Investors push back against the prospect of a ballooning U.S. deficit with 30-year Treasury yields hovering near 20-year highs. Plus, the South African president insists that talks with President Trump were constructive, despite being ambushed by claims of genocide against white farmers. Now, we're just getting a little bit of breaking news out of the UK. You can see some May services PMI actually rising to 50.2. Remember, everything above 50 means that we're in expansion territory. That composite PMI rising to 49.4. So that's unfortunately below 50, but it is a little bit better than the forecast 49.3. Now, Israel Prime Minister Benjamin Netanyahu says he's ordered enhanced security arrangements at Israeli diplomatic missions after 2 embassy staff members were shot dead in Washington, D.C. Now, for more, let's bring in Bloomberg's Paul Wallace, who's with me here in Qatar. Paul, police say basically that a 30-year-old male suspect has been detained. What more do we know?
Hi, Francine. So, yes, they've named the male suspect, a 30-year-old from Chicago. It seems as if he was the only person involved in this fatal shooting of a couple. The man and the woman that were shot were in a relationship. Obviously, we've seen condemnations of this attack from the U.S. and Israeli officials. And they say they're working together to find out more about this incident and obviously to ensure it doesn't happen again.
We don't have a motive or anything at the moment.
In terms of the motive, Washington police said the suspect was shouting "Free Palestine" after he was taken into custody, and it very much seems as if this was an anti-Semitic attack.
Meanwhile, in Gaza, Paul, aid trucks have entered for the first time in 80 days.
So aid has started to trickle in for the first time, really, since Israel blocked it in early March in an attempt to put, it said to put pressure on Hamas to release hostages and surrender. International pressure on Israel has been growing, including from the U.S., to prevent an even worse food situation regarding food and supplies of medicine in the Palestinian territory. So that started to go, and at the same time the Israeli forces are stepping up their offensive against Hamas. They say this is the best way to force it to eventually surrender.
Paul, in the West Bank, the IDF has also apologized after firing warning shots at some visiting diplomats.
Yeah, this was sort of a bizarre, strange incident. Important to note that nobody was injured among this pretty large group of diplomats. They represented everywhere from China to Russia to France to Italy to Mexico, Egypt. They were in Jenin, a town in the northern West Bank. They were accredited. They were with the Palestinian Authority, which governs Palestinians in the West Bank. The IDF says, well, that was fine. They did diverge from an agreed course, and it seems as if IDF soldiers saw them in another part of Jenin, presumably didn't know who they were, and fired warning shots. We don't know how close these warning shots went, but the EU and Italy and Jordan and Egypt, among others, have condemned the IDF and said there needs to be a full investigation into what happened.
Paul, thank you so much. Paul Wallace there with the very latest, of course, from the Middle East. Now, the euro charting a course for its best year in 2 decades. Europe's currency is undergoing a resurgence amid concerns over the riskiness of U.S. assets. Now, our next guest is a top EU policymaker who has said the region should take advantage of investor doubts in traditional havens like the dollar and treasuries. Well, we're joined by Pierre Gramegna. He's managing director of the European Stability Mechanism. Mr. Gramegna, as always, thank you so much for giving a little bit of your time to Bloomberg. Now, I have many questions on the possibility of the euro becoming a reserve currency going forward. But first of all, we're also hearing that some countries in Europe are pushing back against ratifying a new ESM mechanism. Could you confirm that, and what's being done to convince them to do otherwise?
Well, first of all, thanks for giving me the opportunity to speak here. We have a revised treaty which is pending because one country is not ratifying. That is not a new situation. Unfortunately, it's not evolving. But this is not dramatic in the sense that we have the founding treaty that is in place, and so we have all our financial instruments available in case of necessity. What is not in place is a backstop to the fund to rescue banks, which has been benefiting from contributions of banks themselves. So that backstop is not in place, but all the rest is in place.
Yeah, have you spoken to the Italians recently? And is there a way, A, of convincing them, and what do you do if they don't budge?
Well, you know, we are speaking on a regular basis with the Italian government. On the other hand, we have to respect the democracies and the rule of law. So a treaty can only enter into force if it is ratified by all countries. So it's up to the Italians to find the ways to ratify. If there is no political willingness, so be it. But it is not preventing us from being active if necessary.
Do you worry at all about some of, I guess, the firepower, the power of the ESM, or whether any remit could be changed?
Well, in fact, we have a firepower of, as you call it, 500 billion euros, out of which 425 are available. And this is extremely useful in these challenging times with the geopolitical tensions, with wars, as we haven't seen them for a long time. So all of this is creating a lot of uncertainty. The European Central Bank declared yesterday, yes, that the geopolitical uncertainty and also tariffs issues worldwide are a danger to financial stability. And let's face it, financial stability is good for peace, and we are in a time of less peace. So obviously this has an impact, and so we're following that very closely. Our role is also to step in eventually for the 20 euro area member countries in case of risks to financial instability. So not only in case of resolution of crisis, but just also having a kind of prevention role. This is tools that we have similar to what the International Monetary Fund has, and it's good to have that available.
But so how much push do you think will come from certain countries, maybe France, maybe others, to make sure that Europe doesn't regulate too much, that it follows maybe the path of the US and the UK in terms of deregulation? And could you see instability risks arising from that?
Well, I think there has been a recognition by the Commission and by all member states of the EU that there has been over-regulation, and the pendulum has gone too far in one direction, is now coming back, and the goal is not complete deregulation, is simplification. And the omnibus directive of the Commission on deregulation, which is called simplification, is on its way, and it's encompassing lots of things, and so I think it shows the determination of Europe to be more business friendly without compromising with essential issues like climate change or others.
Mr. Gramegna, it's very clear that the Trump administration is actually a full support of cryptocurrencies. What does that mean for Europe?
Well, the jury is out what will come out of the executive orders or the laws that are in preparation in the United States. We're following this very closely in the Eurogroup. We're following this very closely as ESM, as the European Stability Mechanism, as lender of last resort. We are obviously looking at all the things that could have an impact on the euro area, and depending how the regulation on cryptocurrencies or on stable coins is going to be, it could have an impact on the euro area. I think about our autonomy or independence in terms of currency, so it could encourage private companies to issue stable coins. There were initiatives like that in the past that the United States itself did not support, so it needs to be seen if this is the direction in which it's going. I would not like to speculate on it for the time being, but it's something that is on the radar screen of all European governments.
But do you think Europe, we talk a lot about actually US exceptionalism and whether, this is only a bump in the road to more US supremacy, or whether there's actually, a declination of US exceptionalism, and whether Europe, for example, could play a bigger role with the euro as a reserve currency. Is now the time for Europe to make that decision and push it forward if that's what they want?
The quick answer to that is definitely yes. We've seen in the last months the markets being worried about the status of the dollar as the haven currency in the world for many reasons. The unpredictability of the U.S. administration, the tariff issues, now recently in the last days, the last budget proposals, all of this is producing some pushback by markets. And I was at the IMF spring meetings recently, a couple of weeks ago, and all players told us this is an opportunity for Europe. Investors are looking for places that are stable, resilient, that have the rule of law, that are open to trade, and this is really what we have in Europe. So it is definitely an opportunity for us if we do our homework. And the homework means implementing the Savings and Investment Union, which is also in the Letta report. And we, as ESM, are an actor in this, in making proposals. We will have a conference on this in the weeks to come in June. And there are concrete things and steps that we can take short term, like securitization, which has been left behind in Europe. We need pension products for people that need to be incentivized. So there's lots of ideas on the table of things that we can do quickly. But, Europe can only move step by step. It is sometimes slow, but it is a very efficient in the end.
Yeah, sometimes it comes together in crises. Pierre, Gramegna, thank you so much, as always, for joining us. That was the Managing Director of the European Stability Mechanism. Now, Bloomberg understands that the European Union has also shared a revised trade proposal with the U.S. as it aims to inject momentum into talks with President Trump's administration. Well, the new paper is said to include proposals that take into account U.S. interests. It also looks to gradually reduce tariffs to zero on both sides for industrial goods and what it calls non-sensitive agricultural products.
For the past few weeks, there's been discussion on the perimeter, but not on details of the tariffs. I think the period that we're living in is unprecedented due to the uncertainty in markets and the unpredictability of the Trump administration. I hope that things will stabilize and that the Americans will remain simple and loyal partners for the Europeans.
And the European Central Bank says the strong euro and falling energy costs mean that 2% inflation target is not far off. Well, the ECB Vice President Luis de Guindos told Bloomberg that although the impact of U.S. tariffs is still uncertain, he believes it could eventually lead to slower price growth.
We are positive with respect to inflation, and I think that the appreciation of the euro and simultaneously the evolution of energy prices are two positive factors that are going to give an additional push, downward push to inflation in Europe. The impact of tariffs is something that we have to analyze in detail. No? Tariffs in the short term imply that it's a tax on imports, on imported goods. So it's going to be, negative, in the very short term. But simultaneously, tariffs are going to reduce domestic demand and aggregate demand. And I think that, in the medium term, that drop in demand will more than compensate the initial increase in the price of imported goods because of tariffs. It's clear that trade distortions are detrimental to growth. And simultaneously, that the impact on inflation is much less clear, and it will depend on the time horizon that you're considering, that you're regarding. But I would not dismiss the possibility that that trade distortions and tariffs could have eventually a disinflationary impact on the global economy and the European economy. We have to look at the evolution of inflation. We have to look at the projection that we're going to have. We have to regard as well the transmission of monetary policy. But the disinflationary process is ongoing. And we believe that sooner than later we will be able to reach our definition of price stability on a sustainable basis.
Well, that was the ECB Vice President Luis de Guindos. Now, EasyJet reporting first half revenue that missed estimates. The budget airline's efforts to renew its fleet are being held back by slow delivery of new aircraft from Airbus, and that's, of course, due to supply chain challenges. But the chief executive told Bloomberg that the industry is benefiting from lower oil prices.
As we enter the summer, we expect our fuel bill to go down by 8%, and our annual fuel bill is something like 2.4 billion. So that will allow us to offer great fares. We will be looking to pass on the benefits of those fuel savings to our customer, but equally being mindful of other cost positions which may be having different levels of inflation.
Well, let's get more now from Bloomberg's Charlie Wells. So, Charlie, good morning. What's the latest from EasyJet?
Good morning, Francine. So the market is not liking what it's hearing from this report from EasyJet, and it really seems to be latching onto this issue of fleet renewal. So this is a main way that a lot of these budget carriers try to grow. They benefit, as you just heard, from that oil price, but they get new fleets that are more efficient, that burn less fuel. And we are hearing from EasyJet this morning some delays from their supplier Airbus there. So that is not feeding well into the share price, despite the fact that we're hearing some positive news on summer bookings. So this is not likely to change the narrative that we've seen over the course of this year, where you've got EasyJet really struggling to take off in the market, pardon the pun, relative to a lot of its competitors like Ryanair, which just had one of its best weeks as far as the markets go, and Wizz Air. So this report unlikely to change the story there.
Charlie, Bloomberg has also learned that LVMH is warning of soft demand. Is that across the board, or is that because they increased prices by too much?
This is some difficulty for LVMH. They seem to be sending out some smoke signals, at least according to some Bloomberg reporting, that there is softness in the current quarter. Now, we've seen over the course of this year, LVMH having a difficult time, really struggling in the market relative to a lot of its peers. This could be a little bit of a conglomerate discount that we've sort of started to be seeing with this company. This could be some of that hard, soft luxury divide, or this could be Asia. We know that Asia is crucial for LVMH. About 40% of their revenue in the prior quarter came from Asia. So when there is consumer softness in sentiment there, you start to see LVMH take a hit. Now, I want to razor in on a particular area within Asia, Hainan province. This is a popular vacation destination for a lot of Chinese travelers when they go domestic. And what Bloomberg has reported is we are seeing continual duty-free shopping declines there. We've seen them month after month. And what we know is that this spills out into not just LVMH, but into other beauty brands, the L'Oreals, the Estée Lauders, and the Shiseidos. And they are seeing softness in that retail travel space. So softness in China, softness in Asia, spilling out to a lot of these large European companies.
So interesting. Charlie, thank you so much. Charlie Wells there with some of the main stocks that we're watching. Now, coming up, highlights from the Qatar Economic Forum here in Doha. We'll hear from some of the speakers, including Donald Trump Jr. This is Bloomberg.
The Trump Organization isn't doing business with any government entities. They're doing it with private investors. I mean, many of the people in this room probably know them or have talked about them with that. And so, there is a very clear distinction between those things.
Our whole narrow-body fleet will be basically operated by Airbus. We continue to receive 350-1000, and there will always be a chance for another order from Airbus.
The US policy direction around tariffs, immigration, now taxes that are causing a lot of focus on Treasury yields is probably here to stay. You have a substantial amount of uncertainty in almost every market.
Some of the leading business and finance figures we've heard from here at the Qatar Economic Forum in Doha. Now, Bloomberg's Ramana Bersetchi is currently moderating a panel on building AI's backbone. Among the speakers, Doug Adams, the chief executive of NTT Global Data Centers, Mark Ganzi, the chief executive of Digital Bridge. Now, terminal subscribers, of course, can continue to watch that on Live Go. And the curtain is coming down on the 5th Annual Qatar Economic Forum. We're joined by Ziad Daoud, our Chief Emerging Markets Economist at Bloomberg Economics, to talk about some of the highlights. Ziad, it's been so great actually being together for a couple of days and being in the region and understanding really what kind of buzz and deal making there is around the world. How much money are you expecting, coming from abroad to be here, being deployed here, but actually stay in the region?
I think in terms of the relationship of the region to the world, what is more important is the money that's going from the world to the region. So if I summarize the way I think about how the region interacts with the world, I think the region supplies the world with 4 things and gets from the world 2 things. It supplies the world with energy. It's an important provider of oil and gas. It supplies the world with capital, which is why, for example, President Trump was here last week and we have this big conference here this week. It supplies the world with trade routes, like the Strait of Hormuz, the Strait of Bab el-Mandeb, Suez Canal, and it supplies the world with labor. 7% of the world's working age population is from the region. And it gets 2 things from the world. It supplies it with barrels, but it gets the price of oil from the world, which is important for the economies of the region. And it gets interest rates, which is important because monetary policy here is tied to the US, and because what the US does in terms of interest rates determines capital flows and outflows from the region.
Yeah, I mean, on energy, it's an extremely interesting point also because Qatar actually relies a lot on gas. It's LNG that they have the most of, which is linked to the price of oil, which could have a lot of tension with President Trump, who wants a lower price of oil. And within that, you have OPEC Plus also discussing what to do next.
Which is probably why we had the shift in OPEC Plus policy. Because for 5 years, Francine, since 2020, OPEC Plus had a clear strategy, which is basically they will get curb supply, increase prices, and maximize revenue. That changed. That changed last month when they decided to U-turn and surprise market with a larger than expected output hike. That change, and the change was confirmed actually this month when they did the same thing. And there's news today that they might do the same thing in July. And that not only affects oil prices, but also affects gas prices because long-term gas contracts are linked to oil. So it impacts the revenue of the region as well.
Talk to me about the deals. I mean, it does feel, and everyone was talking about the fact that Donald Trump came here, that a lot of deals were signed. Is this a long-lasting partnership? I mean, also a lot of questions about, the aircraft, but we can leave that to one side.
I think, okay, so there is fundamentally, there's a lot of trade and investments going from the region to the US. But if you think about the numbers that came out last week, the 600 billions and the 200 billions and the 1 trillions, I think there is some exaggeration there. We know there was some exaggeration in Trump's first term. He said there was $450 billion of purchases from Saudi Arabia to the US. If you look at the numbers in detail, they're probably less than 300 billion. The region is also spending more domestically, which means it has less money to spend abroad. And also, the biggest economy in the region, Saudi Arabia, has turned from a global supplier of capital to a borrower from the world. And that means, even with lower oil prices, the likelihood of achieving these big numbers, the hundreds of billions and the trillions, are less likely than before.
Yeah, I mean, it feels like there is a dependency, right, between the US and actually the region because they need each other's capital.
Yes, there is the capital dependency between the US and the region, but also importantly, the US is the #1 security partner for the region. There is a sort of implicit pact between the region and the US where the region secures energy supplies to the world, and in return, the US secures the security of the region. But also, there is another big player, which is China. And trade with China has grown significantly in recent years. It has actually outgrown the trade with the US, and now trade with China stands at 4 times larger than the trade with the US.
And Ziad, very quickly, I mean, this is one of the most interesting dynamics, right? Is that you speak to a lot of Qatari officials and they say we don't have to choose between the US and China. Is that true?
I think I'd agree with them. The US is an important security partner. China is the #1 trade partner. The region will find a way not to choose between the two great powers.
Yeah, I guess balancing is really the name of the game if you want to stay in business. Ziad, thank you so much. Ziad Daoud there, Chief Emerging Markets Economist at Bloomberg Economics. Now, coming up on Open Interest, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. That's at 2 p.m. London time. A lot of the focus, of course, will be on dollar dynamics, on exactly how he sees everything with also treasuries. Now, our very own Dimon currently moderating a panel on building AI's backbone. Speakers, Doug Adams, the Chief Executive of NTT Global Data Centers, Mark Ganzi, the Chief Executive of Digital Bridges. Now, terminal subscribers can continue to watch that on LiveGo. We still have a couple of hours of programming here from the Qatar Economic Forum. It is a wrap. It's the last day of the forum. You can continue watching it. I think it lasts until 3 or 2:30 p.m. local. Up next, Bloomberg Brief, and this is Bloomberg.